Okay, so now I'm going to turn to our true potential fund range. What I'm going to do is just examine exactly what the fund managers have been talking about this month. So the first fund range I'm going to start to talk about is the fund range we have with Threadneedle. So our true potential monthly extra income fund. And what we're seeing with Threadneedle is that when they're looking at the UK equities, they are seeing quite a few opportunities. I mean, an example that they've given is BT. Obviously, BT have that huge pension deficit, which the market sees quite negatively. So it means that Threadneedle can pick up BT stock potentially a little bit cheaper compared to other stocks that are in the market. I think they look at a mixture of types of stocks. So they look at very much the traditional income cash compounding stocks, but as well as that, they can look at smaller growth stocks as well. And they do that because it's an extra way to add to return. I think when we're looking at dividend growth, they're saying that they believe equity dividend growth within their fund could potentially grow at around about 3%. And also lastly, on Brexit, they're actually a little bit more bullish around Brexit compared to some of our other fund managers. Okay, so let's move on. Let's have a look at the true potential fund range managed by SEI. And as you look at the returns, I think the first thing to say is that the returns have been excellent. We've seen some really good positive growth from SEI. I think looking at what are the key themes that SEI is seeing right now, I think the first thing they're talking about is currency. So obviously SEI, when you look at their returns, quite a bit of that has come from the positivity around their currency positions. I think what they're saying as well is they hedge out currency when they look at their bond exposure, but they're willing to have unhedged positions when they look at their equity exposure. They expect an interest rate rise in the US later this year, but they feel that actually that'll be fairly modest. I think as well as that, just looking at fixed income, the exposure is very much short duration, so less sensitive to changes within interest rates. That has been a bit of a negative when you look at their returns, but currently they believe that's the best place to be. Okay, so let's move on. Let's now move on to the true potential fund range that's run by Close Brothers. I think Close Brothers feel that the main risks that we're seeing at the moment are political risk. So that is mainly around the US election. As well as that, they're also seeing other risk, which is around interest rate risk. So what happens if the Federal Reserve raise rates? And finally, what they're saying is they're a little bit nervous around what happens with the upcoming company earnings season. Within fixed income, yields have picked up, and actually Close is saying that if this continues, they feel that this asset class could well become more appealing. They still favour a growth sort of style compared to value. And for currency, they're 50% hedged at the moment. And they've done that to reduce risk. It's actually hurt performance a little bit if you look at it year to date, but they're happy with their current positioning. Okay, so let's move on to Allianz. Again, Allianz, the true potential fund range run by Allianz, has performed very well over the month. They were quite cautious in September, a little bit nervous that the Fed could be potentially raising rates. So what they did is they built up quite an underweight position to sterling. So by the middle of the month, they're only about 40% exposed to sterling assets. Allianz have sold down their emerging market bond position, but they are still retaining their emerging market equity position, so they're still happy to be invested within the emerging markets. I think finally what they're saying is any kind of increase in volatility, that they're going to look to increase their positioning towards cash and also carefully managing their sterling US dollar exposure at the moment. Okay, so next let's move on to 7IM. And looking at what are the key themes that 7IM are looking for at the moment. So the first is currency, in particular movements in sterling and sterling's weakness. The second is around intra-market trade among Asian nations. The third, inflation, so something that I talked about within our key themes and the potential for it to pick up. And the final thing is the importance of diversification. And what they're doing here is they're looking to the more alternative areas of the market. In fact, they've actually just hired an alternative specialist to help them gain more access to these areas. Okay, so next let's move on to UBS. And when we look at the UBS fund range, what you can see is that you've seen a positive performance for October in general. The area that performed quite well was they've got a currency hedge fund in there called CARS, and that really helped to lift up returns. The areas that maybe detracted from performance were investment grade credit and their long dated bonds. I think markets are becoming much more increasingly correlated and have only been like this 3 times this century, and it's always because of action that's been taken by central banks. However, UBS do remain broadly positive and regard the current market environment as favouring risk assets. Let's move on to the True Potential fund range managed by Schroders. And we've seen some really good returns from Schroders. And the main reason for that is that they have an underweight position to fixed interest. Actually, if you speak to the fund manager, Marcus Brooks, he said he'd rather hold cash compared to certain areas of the fixed interest market. I think looking further ahead, looking at currency, they see sterling as good value. However, they feel that it could go even lower if there is a hard Brexit, but if so, they feel they'd be looking to buy. Okay, lastly, I'm going to talk about the 2 Goldman Sachs funds, so Goldman Sachs Income Builder and Goldman Sachs Dynamic. Starting off with Dynamic, Goldman Sachs have increased their equity weighting within the Dynamic fund. Biggest increase has actually been to the FTSE 100, so that's now up at 30%. Compared to the strategic asset allocation of 26%. They've done this basically around what they say are their technical indicators, and what they feel is that the Bank of England will continue to defend the economy. Moving on to Income Builder. Income Builder's offered you what's a very good return, but excellent dividend yield prospects as well. And obviously Income Builder pays a dividend yield on a monthly basis. In Europe, they've actually got quite a large position. Obviously, Europe's been hit quite badly compared to the other developed markets, and Goldman Sachs feel like there's some really good, attractive valuations there. Okay, that's everything for me this time. I'd like to thank you very much for listening. If you'd like any more information at all, please use the contact details on the slide in front of me right now. Thank you. Speak to you next month.